Hello and welcome back to Talking Markets. Today we are joined again by Maurice Pomery, Senior Market Analyst at the Corellian Academy. Thanks for joining us today, Maurice.
You're welcome, and nice to be back, Tom.
Perfect. Right, well, let's dive straight in. It's a very big week for central bank interest rate decisions. What are your expectations for the FOMC meeting this week?
So we're expecting more or less what the markets are pricing at the moment, which is either a skip or a pause, if you like, at this meeting. And I think that's probably kind of in the DNA of what we've been hearing from the Fed speakers recently, with a caveat to leave the door open for further rate hikes if needed. There is some pricing into November, and I think the market is still focused on that. So I think it's going to be key to see what Powell has to say about that, if indeed he's prepared to let us know his future thoughts. So, but it's a big meeting all the same. We're going to get the SEPs, the economic projections. So growth forecasts are going to be looked at and sent out again. And the market is beginning to feel that some of those growth forecasts could be increased. That, in addition, is going to add to the belief that we could still have another hike, at least one, from the Fed going forwards, Tom. So the market's going to be looking at these things. The economic forecast could be a surprise. We don't know. But I think generally the market is leaning towards a skip at this meeting, potential hike in November. But there's a lot of things going on in the background that they're going to have to consider. One of those is potentially a slowing consumer, slightly lower consumer sentiment as seen on Friday last week. And I think realistically, the general idea about what's going on with oil and commodities could start to influence with these steep moves we've seen just recently.
If they do end up hiking towards the end of this year, do you see that as being the terminal rate? Is that where it's going to stay? And what will higher rates for longer do to global markets?
I think that's a really interesting question. I think that's one of the questions the market's asking itself. And to be honest, I think higher for longer is still there. I think it's still the sort of central view at the Fed as well. And I think realistically, again, with commodities doing what they're doing, there is a danger that is the next hike the last one. The market seems to think so. There's a very strong narrative right now, particularly in equity markets, that we're going to get a soft landing, which means no real recession, or at least a very mild one. And on that basis, stocks are holding up. If, however, we see this continual rise in oil, commodities pushing up, inflation starting to come back into some of the data, particularly PCE, personal consumption expenditure data, then there's a danger that these rates might not be, this next rate hike may not be the last one. The market doesn't believe that scenario right now, but it's a possibility. And remember, the Fed is open to data as it comes in.
So moving on to Bank of England now. The announcement is on Thursday. What are your expectations from that meeting?
That's a really good question with the Bank of England. The issue, Tom, with Bank of England is that they're a dovish bunch with high inflation. And so it's very difficult to sort of gauge exactly what the thinking is. And the Bank of England, the MPC is split. And there's a lot of doves on that MPC, which is a bit concerning. But looking at this spike we've seen in wages again, it's very difficult to understand how they can't hike again. So personally, my view is that they'll hike another 25 basis points, which is kind of what the market's pricing anyway, so I don't think that'd be a major shock. I think the Bailey press conference is going to be probably more important than the actual announcement itself, because I want to see how he's looking forward, because we had that downturn in growth, which was a bit concerning. Is this another central bank, like the ECB last week, having now to deal with stagflationary issues? That makes setting policy extraordinarily difficult. Because do they hike to kill inflation that could kill the economy, or do they not hike and allow inflation and possibly inflation expectations get embedded and move higher? So it's not an easy task for these guys at the moment.
Looking back, as you just said, at the ECB, they hiked 25 basis points. What are your expectations? Obviously, it's a little while now to the next one, but what are your expectations for the ECB?
I think it was fascinating, Tom, that the ECB hiked on such a close call. I mean, it was kind of like 50-50 going into it. The interesting part of that was that actually bond yields and European yields fell on a hike that was not necessarily fully priced. Now, you've got to ask yourself why. Well, there was a line or two in the statement from Lagarde and in her press conference suggesting they might be done hiking. My own personal view is I think they are, because growth is just shattering in front of them. So I think they have to be careful of that. So I think the ECB are done. They don't want us to sort of really believe that a lot. They want to keep the door open, which is why Lagarde has been walking that back a little bit. But look at bund yields and what's going on with the euro. The market has decided they've done enough.
Yeah.
And we have to remember with these central banks all this week and what the ECB did is that these rate moves lag. The impact lags into the impact onto the real economy by 12 to 18 months. So even if this hike's gone through, it's not going to show up yet.
Yeah.
So the danger is there that they're hitting growth really quite hard. This is a dangerous situation going forwards. Have they made a policy mistake? Will the Bank of England and Fed do the same? It's not clear. We need more data, of course. But that last hike from the ECB might come back and bite them one day.
I mean, what is the solution in a stagflationary environment? As you say, it's an extremely difficult economic topic.
Yeah.
Do you keep hiking to keep that inflation down, or do you increase growth and risk that inflation? What, in your opinion, how do you deal with the stagflationary environment?
Well, I'm probably not clever enough to sit on the Bank of England MPC or the ECB, but in my opinion, from my experience, having seen this sort of thing before, it comes back to this lagged impact of interest rate hikes. So I think the sensible thing for the ECB to have done last week was to wait.
Yeah.
However, the Bank of England doesn't have that capability because we've still got this big spike in wages, which is not going away yet either. So they have to deal with this situation. It's a blunt tool, raising interest rates, because obviously the impact on mortgages and everything else, borrowing costs everywhere, is going to be impactful going forwards. But their situation seems to be different than anybody else's. And I think we are still looking back at Brexit and saying, what happened to all those workers? Is the labour market still very tight? And I think they've got a slightly different scenario. But I think the best way that the ECB could look at stagflation is to be patient. And it's unusual for them to sort of really push ahead with this, but they do have a mandate on inflation, of course, which we have to consider.
Yeah.
But to be honest, it's all backward looking. These impacts are still coming through. And I think if you look at the growth structure in Europe and the UK, it's far weaker than the US.
Yeah.
So we have this US exceptionalism at the moment, if you like, in the data, which is actually driving the dollar higher as well, and is actually leading to sort of more investment into US equities. So underperformance possibly elsewhere.
Finally, we saw with the Bank of Japan, Governor Ueda stated that there's the potential that they might end negative rates by the end of this year. A, do you think that's going to happen? And B, what are your expectations for the Bank of Japan meeting on Friday?
Personally, I think those comments from Ueda were verbal intervention to try and stop the yen getting weaker and weaker. I think this move above 147, 148 is going to be a problem for them. I think the weakening yen does help the exporters in Japan, but it also increases inflation. Inflation is rising. We get that data again on Friday, unfortunately, just after or is it just around the time of the meeting? So that's going to be interesting because the problem is, whilst they've got inflation, they want to see demand-driven inflation, not imported inflation. So the rest of the economy, the domestic economy, is where the focus is now for them. Are they getting that coming through? Not evident yet. So I actually think that you're right, there's going to be no change in policy, Tom, here. It's too early for them. But that means that if US yields stay high and that gap between them and the yen rates is going to drive dollar yen higher again, because people are going to say, well, hold on, they're not going to do anything until the next meeting, which is, 6 weeks away. Yeah. A lot of water can flow under that bridge in between that gap. So I think the danger is here that we're moving into that minefield of potentially physical intervention rather than just talking about it. And the market is prepared to test their resolve by the looks of it, with dollar yen floating around 148. So is 150 a key? I don't think 150 on dollar yen is necessarily the point. Yeah. I think it's how quickly we get there, but also the trade weighted value of the yen, which is very weak against the euro and sterling. But they've now started to move down. So there's probably less rush, but I think dollar yen could become an issue. But it looks like traders are prepared to test the resolve of the Bank of Japan.
Great stuff. I think that's everything from me today. Right. So thank you very much for joining us, Maurice. And don't forget to like, comment and subscribe. And we'll catch you at the next one.